Staying with Spain, the Spanish economy is far outpacing its European peers this year, with growth seen at 2.7% versus 0.2% for Germany and France 0.8%, as it seemingly shrugs off a global slowdown and U.S. tariffs. The Spanish stock market is up roughly 34% this year. That's compared to nearly 10% increase for the pan-European Stock 600 index, with its heavyweight banking sector helping fuel the rally. It is now the top performing developed market index for 2025. Of course, we still have a couple of months to go before the year ends, so let's see how things will unfold. But let's discuss nonetheless what is going on and this higher performance for Spanish stocks with Dan Lacalle. He's chief economist for Stresses Gestion. Dan, always great to have you on the show. I'll start the conversation there. We have been looking very closely at the Spanish economy, how strong it has been, managing to somehow stay away of its global slowdown and U.S. tariffs as well. Just guide us through the performance in the stock market, however, and how banking has been very important in this context.
Hi, Sylvia. I think it's very, very important to understand that, for example, Spanish banks have been very, very prudent in the period of negative rates, and they were building capital at a record pace, as well as cleaning up the balance sheet and strengthening the portfolio in order to provide a much better environment, not just for lending, but also for stability of the financial sector. So what we can see is that the IBEX 35, the Spanish stock market, which is very, very concentrated in a number of stocks that are mostly telecommunications, utilities, and banks and energy. In those sectors, the companies have benefited both from a very strong element of international presence and as well a very prudent strategy inside the country. So the IBEX 35 right now generates more than 60% of its revenues outside of Spain, and that is obviously a benefit coming from companies that have invested very well abroad.
So walk us through the outlook for the rest of the year. Do you think that the IBEX has further legs to grow, or do you think that it has reached the peak here?
Well, I think that the IBEX is facing a number of good tailwinds. Earnings growth looks very robust. Margin expansion remains relatively stable. And I think that if you look at the utility sector, for example, the energy sector, those that are slightly lagging right now may provide a little bit of opportunity for investors coming from new strategy plans and changes in some of the main areas where they're looking to grow their business in the next 3 to 5 years. But in general, what we have to also be very aware is that it's a very mature type of sectors index. And therefore, in an environment in which the United States cuts rates and in an environment in which the European Union is not growing and the world is facing all the challenges that you rightly mentioned, we have to be at least quietly optimistic and at the same time prudent about expecting very aggressive moves. At the end of the day, the IBEX in nominal terms is basically returning to where it was in 2007. It has not reached the highs of that period.
Now, Daniel, I would also like to get your thoughts on some of the defense spending expectations that there are for Europe. This has also been an important market narrative for European markets this year. When I had the chance to speak to the Prime Minister of Luxembourg, he stressed the need to be very fiscally prudent in this context. The Prime Minister of Greece told me the same thing just before the summer. There are some question marks, nonetheless, about what this higher defense spending is going to mean for the bond market. From their comments, do you get a sense that these concerns in the bond market are sustained, or actually Europe has learned the lesson from the past and they are going to be very fiscally prudent even when increasing defense spending?
Yes, Sylvia, it's quite difficult. It's quite difficult to be fiscally prudent when we are seeing the significant challenges to reduce deficits and to reduce debt in France. In Spain itself, which with solid growth is going to deliver still a 3% deficit. So I think that it's going to be a challenge. There's going to be a lot of administering and a lot of really going in detail about the level of spending. But I think that in Europe right now, most countries understand that increasing the expenditure in defense is absolutely critical in order to improve the technological advantages and also to improve the independence of the European Union in its strategic decisions. Therefore, they need to look for ways to reduce the non-essential parts of government spending in order to accommodate for higher defense spending. Greece is a great example of how to do it. Greece is one of the very few countries in Europe that is actually complying with the NATO budget, defense budget requirements, and has been very good at reducing deficit, very good at reducing its fiscal imbalances. So there's a lot that can be learned actually from Greece in this environment, and that could be a lesson for Germany and certainly for France and Spain.
Interesting. Daniel, we're also at a conference where the main topic today is capital markets. We've talked about this before, but when you think about how the ECB has said that they are in a good place, do you get a sense that that might make integration and capital markets union more difficult to conclude, given that the macroeconomic picture is actually a good one at this stage?
Yeah, I agree with that it's quite challenging. It seems that the messages are very clear about the importance of integration, about the importance of an integrated capital market and the banking union. But the banking union is something that is being almost forgotten in the decision-making process in policymakers' agendas. Therefore, what we seem to be perceiving is that the European Union is actually dragging its feet, and we have seen how, for example, the Mario Draghi report was presented more than a year ago, and very little, if anything, has been done about it. So I think that those are things that matter, because on the one hand, the ECB has been able to maintain a very small movement in terms of spreads within the euro area issuers, but that has been at the cost of rising yields in an environment of rate cuts. So we need to look for what is going to be happening in the European Union in terms of the banking union, capital markets union. I think that a lot of the very important things that were presented in the Draghi report need to be taken into account and actually in place.
Right, but a year after the report, only 11% of the recommendations have been applied so far. Let's see what will happen next. Daniel, always great to speak with you. Thank you for joining us this morning. Daniel Lacalle, Chief Economist at Tressis Gestion. Now, for more on Spain's third quarter bull run, make sure you head online to cnbc.com. We'll have plenty of coverage there as well.